What exactly is going on with the mortgage deferral from your side? Hmm.
Banks, they are allowing the 6-month deferral, but they're only offering.
Hey everybody, it's Zen here. And on this interview with Ryan Wiley of Wiley Mortgages, we go through a lot of different things regarding COVID-19. Some of the things we go over are mortgage deferrals, whether it actually affects your credit score. It could be harmful to you in the future if you're trying to get into the mortgage. Also, what happened with the Bank of Canada interest rates and the banks, whether you should still go fixed or variable, and how to close a property if you have one coming down in the future that you do need to close, whether pre-construction or resale. Also, we get a little bit dark about kind of what could potentially happen, but we don't think so. But we all want to prepare you for the worst case scenario if it does happen. So I hope you guys found this episode helpful and enjoyed it. And if you have someone that you may need some of this information, make sure to share with them. Okay. Thanks and take care. See ya. Good day, Toronto. Welcome to the Prime Properties TO podcast here. We are graced by the presence of mortgage superstar Ryan Wiley. Why don't you say hi to everybody, Ryan?
Hello, everyone.
So Ryan is my go-to mortgage broker for anything mortgage related. And because there is so much shenanigans happening right now in the mortgage world, I thought I'd bring him on to talk about a couple things to help you guys out or if anyone's snagged in the situation, Ryan's your guy, okay?
Yeah, thanks for having me, Zen. I appreciate it. You are absolutely right. There's a lot of misinformation out there, a lot of people that can use just some good, solid advice from someone in the trenches. And so thanks for having me on.
Yeah, man, for sure. So I think this is the biggest question everyone's talking about, and it relates to tenants, landlords, and everything. What exactly is going on with the mortgage deferral from your side?
Okay, so this has been evolving day by day, hour by hour. There is a big difference between you have your bank lenders, so your big six banks, and you have monoline non-bank lenders. So there's still publicly traded large companies like MCAP, Financial, RMG Mortgages. So they sort of are treating this differently. The banks, they are allowing the 6-month deferral, but they're only offering 1 to 2 months up front. They're treating on a case-by-case basis. You must be in some financial hardship, obviously. And then they're going to put you in touch with sort of an account manager. And that account manager is going to touch base with you in 30 to 45 to 60 days and reevaluate your situation.
Yeah.
And then there's some thing you have to understand on the back end on how they're going to calculate what your new payment's going to be, because nothing's for free.
Yep.
Albeit if you are in hardship, deferring makes 100% sense. With the monolines, the non-bank lenders, they don't have the 6-month deferral program as of now.
Yeah.
What they do have is they have a skip a payment, which they've always had.
Yep.
Usually comes with a cost. They've decided to waive that cost. And they've decided to give you 1 to 2 months, pretty much no questions asked.
It's pretty good.
Yeah, it's really good. So they're treating it a little differently because the banks are the ones that are being subsidized, and the monoline non-bank lenders, their only source of revenue are mortgages. And so if they just come to a grinding halt and they're not being subsidized, they're not going to be able to keep on all their employees. So this is their workaround for now, is 1 to 2 months, no questions asked, no fees.
Yeah. So for anyone out there, monoline meaning that's the only product that they lend on, which is mortgages.
You got it. Yeah, you call into a monoline lender versus you call into a bank. You call into a bank, you get someone who, don't necessarily know what you're talking about mortgage-wise. You call into a monoline lender customer service. That's all they do every day. So it's a lot better experience.
Okay, so what if people need that for how are they being qualified right now? Because on my side, I'm hearing different things. I'm being told that if you have a newer mortgage, you're not qualified. I had some people tell me if their mortgages, it was with a bank that they're banking with, that they look at the bank accounts to make sure you don't have money to actually get a deferral. Like, how does the qualification work right now?
For the deferral program specifically?
Yeah,
from what we've been told, and I have many clients that went through this process, they're asking a couple key questions up front. They're not looking at bank accounts. That would be a little too big brotherish. To be honest, you've got people, they've had to hire on a bunch of people to accept these calls. The person that you're talking to when you call into the bank, if you do get on someone online after 3 hours of waiting, they have a script and they ask you 3-4 questions, and they 9 times out of 10, they weren't working at the bank. They've hired them to sort of screen the calls, give you instant relief, let you know you're good. They're not looking at your financials. They're just basically saying, are you earning less money? Were you let go? Are things tight? If you go, yes, we're in a bad spot. They go, check mark, you are good to go. But now we're going to send you to an account manager, and that account manager is going to reevaluate in the 30, 45, 60 days.
Now, I guess it's too early to say what the account manager will be asking you, right?
Yeah, absolutely. I think as this evolves, like who knows? This literally things are changing hourly on our end. The
Yeah.
amount of emails we're getting from lenders with different guidelines for this program and just getting a new mortgage, it's changing big time every day.
Got it. Got it. Now, what if someone is going to go for the deferral payment? What is the cost of that? Because we know you said it's not ever going to be free.
Correct.
Yeah.
Yeah. So that's a good question. So, for example, let's just say your payment is $2,000 a month right now, and let's say you have 3 years left on your term.
Yep.
Okay. Regardless of the amortization, that doesn't matter. If you defer for 6 months, the lender wants you to make up that interest that you've deferred. So let's just say $1,000 of your mortgage payment is going towards interest.
Yep.
That's $6,000 you've deferred over 6 months. So an example I gave you of having 3 years left in your term, that's 36 months. 6 months from now, you have 30 months. So what they're doing is they're saying, hey, you owe us $6,000 in interest. You've got $12,000 cash in hand from the savings. You owe us $6,000 in interest. You have 30 months left to payment. They just divide the 6,000 by the 30, and what's that? $50 a month, give or take. They're going to say, hey, your mortgage payment now is going to go to $2,050 at the 6 month mark to the remainder of your term, and that catches your amortization back up. That's what some banks are doing. Other banks are allowing you to defer that interest, that $2,000 or $6,000 that you did defer, over the remaining amortization of your mortgage. So if you have 20 years left, and you divide 20 years times 12 months divided by 6,000, it could work out to be $5 a month. Yeah. So your payment could be $2,000 in 5 months, $2,000 in 2005.
Don't worry, we won't put you on the spot. Let's not do math live, okay?
Yeah, well,
it's not a good idea.
So that's sort of what they're doing the calculation. Each bank is doing it differently. And then the only other question is, are you paying interest on top of interest? Well,
exactly.
Yeah, you are, absolutely. But what do you expect?
Yeah.
The banks, they've got shareholders, stakeholders. The media is telling us that the banks are there for us to help us. They are and they aren't. The government is telling us that, but the banks are there running a business, and you're borrowing money, but it's 3% interest month on average. And yeah, so if your interest, it's going to get added on your other interest. That saves you from losing your home.
Yeah.
Or stressing out and getting divorced. That's you run and you go, where do I sign up?
Yeah. So is it good to assume that whatever that interest rate, let's say, is $6,000 that you accrue in 6 months, are you now having that $6,000 compounded on the balance of your term of the 3 years in your example?
Correct. Well, no, it depends if they're asking you to pay it off in the term or ask you to pay it off over the AM. You'll pay more for it if you put it on and pay it off over 25 years versus pay it off being forced. But then cash flow comes into play. $50 extra a month in that scenario, that might hurt you. I don't know what your personal scenario is, but the quicker you pay it off, obviously, the less interest you're going to pay. But it's still so minimal. Like, yes, they're making money on the money, but you also got to live in a home with no mortgage payment for 6 months, and so there's a trade-off there. The 3% on the 6,000, it's so minimal, the amount of interest.
It is. And I think a lot of this is to make sure there's no stress on the families, right? Because if you're, worried about losing your job, worried about losing your home, it could go into chaos pretty quickly.
Absolutely. So if someone in a time of stress, if someone's willing to give you $6,000 at 3% interest, you take it.
I would even do it for more. I mean, 3%, I'll buy houses with that.
Yeah, I know. So that's what they're doing right now. The math is not as bad as you would think, especially.
Okay. Got it. That makes a lot of sense. Now, if someone needs, like I say, a deferral, and it's going past every few months or so, do you have any idea how they're checking on you moving forward? Like, if you have a job, then they're going to check on you and then cancel it? Or is it just you get straight, like 45 days after every single call from your account manager?
Yeah, there's a little bit of an unknown right now. We really don't know. I don't think the banks really know what they're doing.
I see.
It's call it what it is. They just don't. That's not a slight against them. It's just there's so much information, so many changes coming daily you've got employees at the bank that are still absorbing all this information. Common sense tells me they're going to touch base and just go, okay, are you still unemployed, or things still tight? I think at some point they are going to ask for some sort of proof. If that's ROE, record of employment, if that is maybe 1 or 2 months or 3 months bank account statements to show what you were taking in deposits and what you are now.
Yeah.
I think at some point, I don't think they're going to just go, hey, hands off 6 months because you tell us. I think they're going to actually underwrite the deferral at some point.
Got it. Okay. So anyone out there who's trying to take advantage of the system, don't be that guy. Just if you need it, get it. If not, then you don't need to, right?
And you know what? There's something, absolutely, if you don't, but some people, here's the other thing, people have credit card debt. The average Canadian has $9,000 of credit card debt. And so if you're sitting there with credit card debt and you're sitting there with a mortgage payment and times are getting tough and you can make one or the other, defer your mortgage and use the savings, take 6 months of deferrals and pay down your high interest debt. That's what I would do, because the credit card companies are less forgiving. And even if they forgive the interest, well, that's just going to get compounded, 18, 24% interest, compounded. So just because you can make your mortgage payment, if other things are suffering or getting tight, I still think that qualifies as taking advantage of the deferral program, because the high interest debt is going to kill you.
Actually, that's a really, really good point to do, because like a lot of people, if you're watching this, you don't understand the interest on mortgage for money you borrow tends to be very, very low compared to anything else you're going to get. So it's better to pay off things like your credit card.
Put it this way, the banks, they're making money off you big time, and they have for decades on your credit card. Let's flip the switch on them a bit, turn the tables, defer the payments, take that $12,000 in mortgage payments in that example I gave you, and pay off $12,000 of high interest debt.
For sure. Now, what have you heard from the credit side? So if anyone who's deferring their mortgage, I know I read an article from a newspaper I won't name saying that if you get a mortgage deferral, you're going to get a hit on your credit right away.
Can I name the newspaper?
Sure, go for it.
Okay. I've read the articles too. I can only tell you from the experiences we've had with our clients. We deal with the majority of A lenders in Canada.
Yep.
I've heard from the horse's mouth that this is not going to impact your credit. If you miss a mortgage payment, that will. So a lot of people think that, oh, I can just miss a mortgage payment. No, you have to apply. Mm-hmm. Don't confuse that. But once you got your payments deferred, this will not come back to bite you. But where it could come back to bite you, potentially, is this. Let's say your mortgage is up for renewal in 10 months.
Okay.
And let's say you did 6 months of deferral. So that essentially is put your added amortization back onto your mortgage. You're in a negative amortization situation. You become a free agent at maturity. Your mortgage matures in 10 months. Well, if you want to go somewhere else to another lender, your amortization is over what it should be. If you're supposed to be at 25 years, now you're at 25 years and 2 months. Mm-hmm. Another lender is going to look and go, what happened here? Oh, you took advantage of the deferral program. You're not so exciting to take on now. Fine. And don't kid yourself, the bank that you're with, the lender you're with, they've got all the intel. They know if you've deferred payments. And so your mortgage comes up for renewal. They're going to second guess who they're going to give mortgages to. They might underwrite the deal. They never used to check for income, never used to check for credit. They might do soft pulls, and they might want an updated pay stub because, hey, 4 months ago, you took 6 month deferral and now your mortgage is up. We don't know if we want to get into bed with you.
That is true. So
that's not being talked about.
Well, this is why we have you on right now, because this is why you're here. So then let's say, you and I both deal with a lot of investors. Let's say you're an investor, you have investment properties, and your tenant can't pay rent, or they can pay rent. Is it wise to take the deferral, use it for something, or try to help the tenant out in a way that if they have lost their job, you could defer their rent payments or whatnot? But we're going to take aside the legal side of it, but just from like the mortgage perspective.
Yeah. And they just came out recently and said, hey, you can defer rental properties now. So that's great relief.
Oh, sweet. Okay.
Yeah, they came out and said that. That was
all banks
on Sunday. As of right now, from what we've heard, it's RBC, Scotia, and TD.
Oh, sweet. Okay, we'll talk after.
Yeah. So here's my thoughts on this. If you have rental properties and you have tenants and whatnot is you need to get ahead of this a little bit. You need to open the line of communication with your tenants. You need to reach out to them, even if they are, solid, never miss a payment in 5 years, and just go, hey, what's going on in your life? There's something I need to be prepped with. Okay, your hours have been reduced. Your rent is $2,000 a month. Can you afford $1,000 a month? Can you afford $700, $1,200? I just need to know what we're dealing with. I want you to stay in the property. I'll get it from you. You can make me whole at some point, but I need to know how much is coming in so I can balance out my cash flow. And then, I would go, hey, first I would look at using a home equity loan. If you have one already on the property, I would look at that as an insurance policy. We set up all of our clients with home equity lines on, try to do it on every time they get a property. For rainy days like this isn't a rainy day, it's a little more, but so I would recommend that, tapping into the HELOC, and as a worst case, I'd get the deferral payment in going, at least knowing you have it there, because you can also tell them and say, hey, I don't need this anymore. Or you can hold it in a reservoir, keep it in a savings account, and at the end of the 6 months, 8 months, 10 months, if you didn't need it, you can just do a lump sum right back and get your amortization back on track.
Plus whatever little interest that you would have incurred on it.
Peanuts.
But you know what, like even at say 3% interest, having that kind of liquidity personally, it could alleviate a lot of stress on the off chance something happens further, right?
Cash is king right now. So liquidity, if you can have that, it doesn't mean you get it and you go spend it, although there's nowhere to spend money right now. I've never spent this amount of money in my life. It's kind of cool. I'm like, whoa, that's what you can save up some money here. This is great.
We've been doing a lot of Amazon shopping for the cocoa. So it's just like boxes and boxes of dog stuff coming in.
I know. So, but me personally, I would get the deferrals going unless you were, set up and then some behind the scenes. But I would reach out to every tenant, even if there's stuff you don't want to hear. I'd get ahead of it, because a lot of tenants talk to a lot of tenants and they're like, can't afford the $2,200 a month, or I'm worried, but I could afford $700 or $800.
Yeah.
And I'd be like, great, let's start with that.
Yeah. And just so everyone knows right now that you're listening, we're recording this as of April 1st, and this is technically the rent apocalypse that's supposed to happen with tenants not paying rent and all that stuff. So we'll hear in a couple of days what's going on, but it's good to hear that if you, the investor, have tenants, the deferral program is available for you now, effective 3 days ago.
Yeah, absolutely. It's there, finally.
Yeah, no, that's good. That's really good to hear. That's great news. Okay. There's one thing that I think everyone's going to ask you, and I've been curious too. I've heard from my side what's going on and a little bit from you, but what the heck happened with interest rates and the mortgage rates and everything that kind of with the massive Bank of Canada drops? Like what exactly happened? Because it kept fluctuating up and down, up and down, up and down.
Up and down. And really the only thing that we've been spoon-fed from the media and our social feeds is that interest rates have went down. And that's what we've been hearing for weeks. And I will tell you right now, they did go down.
Yep.
They went down for a couple days, a small window, maybe a week window. But there's two things happening. You have the variable and the fixed. And they're both telling us different stories. So you have the variable rate where the Bank of Canada rate, the overnight lending rate, was 3.95%. And then variable works like you have a spread off of that, a discount. So it could have been prime -1, for example.
Ryan, I'm going to stop you there for a sec, because I think one of the things you explained is very high level. So what is the correlation between the Bank of Canada's interest rate and the prime that you see from the bank?
Yeah. So they're two and the same, really. It's just they're called different things. And so even though prime lending rate is 3.95 that everything's branched off of, each bank has their own prime rate.
Yep.
It's a matter of if they align it with the Bank of Canada. So the Bank of Canada is right now at 2.45%. Okay. The lenders, they've all reduced theirs to 2.45, but it took them a week. It took them 3 days. TD didn't pass on all the savings a couple of years ago, and TD kept their prime 15 basis points higher. So TD is 2.6 right now. Okay, so when you hear the overnight lending rate, the Bank of Canada drops the rates 0.5%, like they did 3 times in the last 2 weeks, those savings don't have to be passed along to the public.
Yes, and I think that's very key. Yeah.
They don't, but there's a lot of social pressure, and there's a reason it did happen. We didn't know if they were going to, and then after it did, it snowballed, and every lender finally did it. But there were lenders holding on for 2 weeks, not doing it.
Yeah.
They were trying to squeeze out as much profit as possible. And then they did. And it doesn't happen instantly. Just because your rate gets reduced on a variable by 1% or 0.5% overnight, each lender treats it differently. Some of them treat it at the beginning of the month, and some of them every quarter. So, but same thing, if interest rates go up, your interest rate doesn't go up until the end of the quarter.
Yeah.
Okay, so don't expect your interest rate to, go up and down as quickly like the price of gas every day. It takes time to work its way through the system. Yeah. So with the variable rate, you've got, right now we're sitting at a 2.45 prime lending rate that all the banks are using.
Mm-hmm.
But what is gone now is that discount. So the bank said, okay, well, we're not going to give 1% interest rates out. The prime -1, prime -0.5 that we've been seeing for the past 7-8 years, that's gone. Now it's prime plus.
Yeah.
So that's how they corrected that themselves. It's prime plus, let's call it 0.25 on average.
Yeah.
That makes your interest rate 2.7% on a variable.
So that basically makes a variable net the same before all this interest rate drop.
Yeah, maybe not when it was 3.95, because 3.95, if you were prime -0.5, you'd be net out at 3.45.
Mm-hmm.
But definitely before the last move that we just had, when the prime lending rate was 2.95. So that's what they've done. So if you have prime -1, you're laughing. If you're prime -0.5, you're laughing. You're sub 2%.
Yeah, we have some of those.
But new people looking to get new funds, they're not reaping the benefits as much as they thought. You're not going to get anywhere close to 2%, like anytime soon, if ever. Okay. Yeah. On the fixed side, things are different. Things drop down instantly. We were looking around the 2.3 range, 5-year fixed for a couple of days. They jetted up, and basically what happened is there was no liquidity in the market, meaning that the price of funds that banks borrow, they borrow from each other, they borrow from investors. There were no investors that wanted to play and lend money out to people because they weren't getting a big enough return, and it was too risky with what's going on in the world.
Mm-hmm.
So they went and put their money into bonds and whatnot. And to get them back, to free up the liquidity, meaning to put more money in the market to lend out, the interest rates had to go up. And so the interest rates went up, and right now they're in the low 3% on a 5-year fix. And now there's investors coming back in, and there's a lot more capital in the market.
Got it.
That's what's happened. So variable rates did go down, but then to offset it, the lenders came back and removed the discount, and fixed rates took a shot down, and they've been inching up, and we anticipate them still inching up more over the next 6 months.
Yeah. So then what would you recommend to someone who's closing a property, fixed or variable right now? And I won't hold you to this. You and I have the same sentiment, but what would you say?
Yeah, I'm variable without a doubt. I'm
a
big fan on the variable. And it comes down to this. It comes down to the penalty. So 60% of Canadians break their mortgage in the first 3 years.
Yeah.
And knowing what's coming now with the ripple effect with employment and unknown property values, we anticipate the amount of people that have to dip into the equity in their home, or even just sell their home in general, to go up. So that means more people breaking mortgages. If you're in a fixed rate mortgage, the IRD, interest rate differential penalty, the banks, they will kill you.
Yep.
They will get you with a $20,000, $30,000, $40,000, $50,000 penalty. An example with a 3-year variable, or sorry, a 3-month interest penalty on a variable, which is what it is, first month or 50th month, it's an average of 0.75% of your mortgage balance. It's 3-month interest. It's the lowest penalty in Canada. With a 5-year fix, with a big bank to boot, depending where you are in your term, it could be anywhere from 4, 5, up to 7% of your mortgage balance. So compare that to a 0.75 in a variable. So you get maximum flexibility, especially going into the big unknown here over the next 12 to 18 months.
For sure. Let's put these numbers, and it doesn't have to be exact, but let's put these numbers like for real life situations. So let's say you have $500,000 mortgage and you're going to break that in 2 years. What's the cost to break that in a fixed, and what's the cost to break that in a variable? Roughly.
Yeah, it's a loaded question because there's different variables on the fixed, but for the variable, it's, $500,000 mortgage, 0.75% of that, you're at probably $3,700, $3,800.
Yeah.
Charge fee. So you're at about $4,000. With a fixed rate, depending where you are in the term, and if you're with a bank or a non-bank lender, you're looking at $25,000 to $35,000 penalty.
Yeah. And so this is why, like Ryan and I always recommend anyone who's an investor, even personal reasons, life changes. Black swan events like the COVID-19 happen. And that's why, even though you may pay a little bit more in variable over each month, maybe like $50, $60, the flexibility and the options, if something hits the fan, at least you don't have to pay that $20,000, $30,000, $35,000 penalty, right?
Yeah, I've been preaching this for years, and it was only the past couple of years where the variable was actually higher than the fixed.
Yeah.
A lot of people were going into that fixed. Those people now, they're looking to tap into that equity. And unfortunately, they're getting in some tough spots right now because they chose upfront savings on a month-to-month basis of $30, $40, $60 a month over flexibility down the road.
Yeah. And like, I think it's normal human nature to know the fixed costs, and it's totally normal. Like, I was even up against it, but I listened to my own advice and I said, look, I already know that I need the flexibility for variable coming up. And I've never seen a client be like, oh, I chose variable. It was a wrong decision. Most of the time they refinance, they put lines of credits on it, or they sell it. And they're like, oh, thank goodness you told me not to get fixed.
You got, I don't know if you, well, yeah, you definitely remember, but a couple of years ago when, 2017, variable rate shot up for the first time in a long time.
Mm-hmm.
And a lot of clients that went, it's kind of like ride or die. You got to stay with the variable. You can't lock in.
Mm-hmm.
Those clients went up. They got so weirded out with what was going on in the market against advice saying lock it in or don't lock it in, don't lock it in. They locked it in at a 369 to 389 fixed.
Ooh, ouch.
So, yeah, with penalty attached to it. And now, they would have been in a much better spot. And so it's sort of lesson learned. If you're going to take a variable, you got to ride it out, even though the banks dangle you locking in. Put it this way, the banks had never called you. In the past 11 years I've been in the business, the bank never reaches out and goes, hey, there's an opportunity for you to save money. Hey, do you want to lock into a fixed? They were calling. They hired people to just make calls to their variable clients to get them to lock in because they knew what was coming. Maybe they didn't know this was coming, but they knew we're going to win. As soon as we get them locked in, our portfolio goes up. We get guaranteed IRD penalties triggering. It was interesting. Hey, interesting. My bank just called me and said I can lock in my variable.
Yeah, I've had so many clients call me about that and I have to explain it. And the best way I've explained it was, look, if the bank is offering you money or ways where you can fix it in, there's clearly a reason why they're doing it. There's no free lunch.
Yeah, and like this really isn't a on the bank thing. I don't want
to. No, it's not. Let's not turn it into that. Yeah, the banks are great.
They're the backbone of our, economy and whatnot. But there's a method to their madness.
Yeah, it makes sense. Yeah. Now that we talked about variable and fixed difference, what do you recommend for clients who have upcoming closings that they went firm on before this whole pandemic exploded?
We're seeing some issues there.
Yeah.
So what I recommend, if you went firm and you've got a closing coming up, is first off, open the line of communication. If someone bought your home or you bought a home, you gotta pick up the phone and figure out, hey, is there someone you need to be worried about? You need to let them know, hey, no, we're still good. I will tell you this, I would be having conversations with family members about co-signing. You sort of have to work out a worst case scenario.
Yeah.
Because what's going on now is a lot of lenders, if they've already satisfied your income, some of the big banks are telling us you're good.
Yeah.
Other lenders are telling us if you're in a non-essential, if your job is non-essential and deem that, we're going to be coming back in and asking for potential pay stubs a little closer to employment, because we want to see if you're not going to be forthcoming and telling us that you're working 10 hours less a week, we're not working at all, then we're going to check 2 weeks before closing. And so you need to have a contingency plan.
Yep.
So I would be talking to family members. I would be talking to whoever has advised you on the mortgage and sort of work out a worst case scenario, a private mortgage scenario. You just need to see numbers on paper, knowing that you can close. You might not like the numbers on paper. You might not like going to mom and dad and asking, but it's something you need to have these tough conversations, because we've heard all sorts of different things that's coming down the pipeline, even up to appraisals being redone. So appraisals are typically good for 30 days.
Yeah.
But if you bought something and closed in 70 days and you had the appraisal done, you're usually good. Now some lenders are coming back saying, hey, that appraisal is going to expire, and we might, because of what's coming here, we might need another appraisal done. So you
Yeah.
need to prep yourself for that.
And anyone who's wondering what the appraisal may come back at, it may come back lower, because I still think that in the short-term future, prices are going to come down. And when you compare properties where they just got sold by a seller who's in dire need to sell to close another property, they're going to compare it to the most recent ones, and then your appraisal can come down. And then when the appraisal comes down, if it doesn't match what you bought it for, you're going to have to bridge that gap between the appraisal and your purchase price yourself personally, whether it's cash or private. And that's going to be a tricky situation.
Yeah, no, absolutely. So I can't stress enough the lines of communication. I know I keep saying that. It's like the Sesame Street word of the day. You you need to open those lines, because people aren't. They're putting their head in the sand, and they're just hoping this blows over, and they're hoping that no one comes calling. I'm telling you, once the banks get out of what they're in now, which is dealing with deferral payments,
Yeah.
they're going back into underwriting files, and they're going to open up your file again. Don't kid yourself.
Yeah. So make sure, if you are deemed an unessential employment, and we're not, crapping on what you do, it's just, it could become a problematic situation in the coming months, right?
Yeah, and it already is. We're seeing deals where clients who they were slam dunk a month ago, now, and even though their work hasn't been downgraded, they're still fully employed. They're saying, hey, what sort of savings do they have? We think that their business is going to go this direction. We think there's going to be work for them in 2 months. So what other assets, liquid assets, do they have? Do they have parents that could co-sign? So these are the conversations that we're having.
Wow. Okay. Now, I've also heard that some clients of mine have been asked to come up with like 40, 50% down payment, as opposed to, the 5 and 20%, because they're worried about the loan to value ratio on these mortgages. True?
Yeah. Well, under 20%, so that's insured with CMHC, Genworth, or Canadian Guarantee. I haven't seen those treated differently, because they were already going in with not a lot of skin in the game, and it was an insured product. But you are right. The 20%, 25, we've seen some lenders go from deals where it was 20% down payment. 1 week later go, we need 30% now. So they're insulating themselves on the value, because they know there's going to be a dip here in values, and they don't want to have their portfolio. If you're a lender that only lends with a minimum 20% down, a lot of lenders do. Mm-hmm. Well, if there's a dip, now all of a sudden your portfolio, the loan to value is 90%, 85%, meaning there's only 10 or 15% equity. That's below the promise you made to your investors.
Yeah.
We're only going to lend your money out to people with 20% down or more. So they're building in that security for them. Mm-hmm. And it's just a matter of time before the banks come back and insulate themselves from a 20 to 25%. That's my prediction. I think that I didn't want to get into predictions, but I do think that's coming at some point, and definitely for investors.
So you're thinking that the down payment for new investment mortgages will increase?
I do. I think it will. It might be short term, but TD was already there. TD Bank was 25% already before this, and they were doing 20% down payment on exceptions. And so it had to be like a really clean file for them to do that. So they already went that direction. So this is just going to solidify that at some point. Once they figure out the deferral program and how to handle all that traffic, the rental portfolios that's the next target, I've been told.
Got it. So having said that, what would you recommend from a strategy side for someone who's kind of in between some of these situations that we're talking about? Like, what's the best way to make sure that you're not breaching a contract, or you're fulfilling your contracts, whether it's pre-construction or you closed on a property, you haven't sold one? Like, what do you recommend for strategy to close right now?
Well, to close, you can only control so much. You really can. So this sort of goes back to the earlier question of have a contingency plan on closing. I can tell you, me personally, what I would do if I'm in a situation, I got a closing, or even if I don't have a closing coming up, I would try to reduce my monthly payments and get active capital. So I would be reaching out and trying to put home equity lines on all properties that I can. I would be reaching out and going, can I re-amortize my mortgage? Which that could shave off $100, $200 a month. It could be a short-term thing for you, and then you could get back on track. I would be looking at changing my accelerated payments to standard payments. That itself right there could save you $100, $150 a month. I'd start looking at all these ways to optimize my liabilities and to get access to capital if I truly need it. It starts with reaching out. Unfortunately, the banks, they're just, obviously I'm a mortgage broker and I'm a pro mortgage broker, but mortgage brokers are the only ones actually picking up the phone right now.
Yeah, I know.
They just aren't. They can't. It's nothing against them. They just physically can't. So many people calling. So I'd reach out to a mortgage broker, I'd reach out to somebody and I'd say...
For everyone that's not watching this on YouTube, Ryan's pointing at himself, just so you guys know. And I will leave Ryan's contacts on all the show notes and description for you guys.
But I would, because a quick phone call could kind of just go, hey, there's an opportunity here for you to save $300-$400 a month. And, why don't we look at a refinance? Why do we, your pain points right now are different than they were 2 months ago.
Yeah.
And so you owe it to you and your family to at least have the conversation and look, see the numbers on paper as to what you could actually do and if that's going to help you sleep better.
Yeah, so it's kind of like just freeing up liquidity or having cash on in case emergency happens, and you're just like restructuring your house or your investment properties mortgages, right?
Bingo. It's the same thing I would do if you were looking to grow your portfolio.
Yeah.
And, you get to write off a lot of the interest on the mortgages, or all the interest on the mortgages for investment properties. This is that same type of strategy. It's just this is a different use for it.
Yeah,
so
exactly.
Optimize. I would look at optimizing your mortgages, but not everyone knows how to do it, unfortunately.
And this is very key, and why I always tell people, look, you should talk to my mortgage guy, because most mortgage brokers don't understand the flow and how to optimize for these situations. All they're focused on is, hey, I'll get you the deal, I get then a lower interest rate. But it's not always about shopping your rate. It's about the options and how to strategically plan. So, in this session that Ryan and I are having we're talking about the COVID-19 and how you're trying to help you guys out. But when this is over, we're going to talk about this again later on how you can buy more investment properties, how you can be one property away from retirement. So this is why it's key to have a very good mortgage broker who understands this, and it's not just about schlucking paperwork.
Yeah, agreed. The investment properties, which I know is your specialty, it's a different beast.
Different ballgame.
And there's only so many people that actually are investors themselves or have spent the time developing the skill set to do it.
For sure. Let's circle back to the refinance right now. So how's the refinance situation looking right now?
Well, that's what we've been doing this past couple of weeks. We've been doing a ton of refinances. So they're still doing it. The banks are still open for business. They just want a little more detail as to kind of why are we doing this? If the income, I'll tell you this though, if the income has changed, it's changing how much they're letting you borrow. And so they're scaling back the loan to value, meaning you used to be able to leave 20% equity in your home and borrow everything else minus what you already owe on a mortgage. Now they're saying, if your income has changed, or you're in that industry that we deem non-essential, or you don't have other liquidity, or we don't agree with what you're doing with the funds, we might make you keep 25 or 30%.
Yeah.
Interest rates, there's always a little premium on refinances.
Yep.
It's a 5 basis point. It's minimal.
Very minimal.
You're allowing people to jump up to a 30-year AM. I recommend this with all clients, regardless if you're buying a property, refinancing, rental. Always, always, always take the 30-year amortization. And the reasons just like this. Let's say you want a 25-year AM, and you're like, I don't want to pay more interest. You don't have to. Take the 30-year, on paper, your payments as low as possible, and then increase your payment ongoing right after closing. That gets you right onto a 25-year AM, and nothing's changed. Your amortization is on schedule. You're not paying more interest. But in scenarios like this, where you need your payments to be lower to free up cash flow, you can
back it up.
One phone call and go, please put it back to a 30-year AM payment. Boom, that's going to be $300-$400 a month more in your pocket. And then also, if you're an investor and you're setting yourself up to build your portfolio out, well, down the road, at some point, it just gets hard to qualify for properties. So you actually need the lowest mortgage payment on paper possible, which is a 30-year amortization. So it's setting you up for future growth.
Exactly. And also from the real estate side, you're going to get more cash flow when you have 30-year amortization.
Yeah. Yeah.
And these are things they don't really teach you anywhere. Like there needs to be like some kind of financial literacy school, because I was always growing up with, pay down your interest rates as quick as possible, accelerate your mortgage debts. Oh my God, I can't pay this $10,000 interest over the course of 30, 20 years. I must pay it in 15. It doesn't work that way. In reality, it doesn't work that way.
It's short-sighted.
Yeah.
It is. It's what we were taught. But having a 30-year AM, there's no negative side to having the 30-year AM, because you still get to control with the prepayment privileges what your true amortization is. But you lose flexibility. For all the people that took a 17-year amortization, they're stuck with 17-year amortization payments right now. If they had a 30-year amortized, they could free up probably $8,000-$9,000 a month in cash flow.
It's pretty substantial right now, $8,000-$9,000.
Yeah, absolutely.
Yeah.
Absolutely.
So if someone is they're trying to refinance or trying to get some more liquidity in their life right now for COVID-19, do you think, and I won't hold you to this, that they're going to start looking at the emergency aid as a type of income?
Yeah, that's a good question. Put things in perspective, they just started, most banks, accepting child tax benefit.
Okay, yeah.
So, and that's been around a while. And now your kids have to be a certain age and whatnot. So I can't see, excuse me, I just can't see. It's kind of like you're robbing Peter to pay Paul, if that's the saying. We're going to give you money over here, and then we're going to give you the benefit of us giving you money over here to qualify to give you more money.
Yeah.
So I would say I can't see they're going to allow for that. They're
Okay.
just going to not let you refinance.
Right. So what do you think after all this COVID-19, because I know you and I work with a lot of investors, what do you think this is all going to mean for them, say in midsummer, when potentially, knock on wood, this all blows over?
I think it'll be a wake-up call for a lot of people, because let's be honest, you bought a property, even if it was the wrong property, and you didn't have your mortgage optimized and you didn't have the right people in place helping you, you were winning, because everyone
the market's great.
Real estate. And so now we're faced with some adversity for the first time in a long, long time. And so now you actually have to treat your properties like you're running a business. And you should have always been doing that. But I think this can be a wake-up call for a lot of people, that they're going to realize, geez, I need to have true professionals over what I do, because the bank is where I get my investment property money from. Yeah. And they won't even pick up the phone when I call now, and they're not giving me advice. So number one, I think that's going to happen. I think you're going to realize, wow, I should have people take care of this, that this is all they do for a living. Number two, I think they're going to realize, I think the value of real estate, much like you said, I think we're going to take a little dip here.
Yeah.
I think it'll plateau pretty quickly after that. And I think kind of 18 months from now, we'll be back surging to where we were before. Everything's built on if tenants are paying rents. That's what it's built for. So I think this will slow down investors' growth for a little bit. I think they're not going to leverage themselves as much as they were initially, and a lot of people were leveraging themselves quite a bit. If anything, this will just allow investors to spend more energy and time looking at their portfolio. We'll end up 10, 15 years from now, generational wealth out of this. Everyone's going to win big time. I think the biggest thing I referenced it is just to come out of this with a better team around you.
Yeah. I know you and I have been busy the last week or so, just dealing with mortgage scenarios for our clients, and me dealing with a lot of tenant situations regarding this whole no paying rent and how to deal with it. So this is, again, it's not to toot our own horns. It's just, this is what Ryan and I do all day, every day. And we talk about this all the time. So we encounter these issues, and in a good market, in a bull market, anyone who buys anything and you just point your finger on the map in Toronto, you look like a genius because the market's going up. But it's times like this where you really need to know what you're doing so you don't get caught on the wrong side.
Yeah. I couldn't agree with you more, man. This is interesting times, and this is great. No one loves this situation, but this also, it just validates what you and I do.
Yeah, exactly.
It's kind of we are true professionals in this, and it just makes you realize, wow, okay, pretty good at what we do here. And you sense that from your clients, because I'm sure your clients are saying the same thing to you. Like, I'm so happy I have you in my corner. You pick up your cell phone and call. Like, I'm very appreciative that we can just call you and get answers for all this.
Oh, that's the best. Like, I never ask for anything for anybody. Like, I don't ask for kickbacks or anything. All I want is anyone I work with, I'm like, hey man, when I call the phone for emergencies, can you pick up? That's all I need.
Yeah, yeah, totally. And so your clients, they're calling, you're picking up, and you're working out different scenarios for them. So we're all hands on deck here. I know a lot of people are slowing down, but we're not.
Yeah, there's so much tenant issues that we're dealing with. I'm hoping it kind of blows over by the end of this week and everyone kind of sorts the tenant issue out right now.
Yeah, the big unknown right now, like you said, April 1st. So let's see. I think people had a lot in their reservoir. So I think some people, they had a reservoir.
Yeah.
Big, but it's next month. Like, I think that'll be more of a ripple effect of the next month.
Are you hearing any kind of like numbers from your side? Like, I'll tell you, like, from what I've heard, like, I have most of my investor clients, they're okay to last like a month or two. But after that, because I've always preached, have 2 or 3 months emergency fund for whatever reason. I think most of them have that 2 or 3 month emergency fund. That's about it.
Yeah, you know what? Like, every investor, the client I have, our goal is to set up a home equity line on that property. Yeah. And so if you put a 20% down payment on a rental property, you put a home equity line there, you can't actually access any of that money right away.
Mm-hmm.
But we've set it up on an island so that your family budget is insulated. So if something happens like this, you start paying down that principal, and let's say you've worked for 2 years, well, that could be $16,000 that's now available on a home equity line.
Mm-hmm.
So that could be 3, 4, 5, 6 months. So if you had set it up that way, or if you don't have one, run and try to get one now. You set it up that way. Our investor clients, for the most part, they're good because we've given them that tool, and they might have had to pay a premium for that tool. They seriously
now it's worth it.
Had to pay 0.2% on the interest because other lenders weren't offering a home equity line, so they're giving you a lower interest rate.
Yeah.
And I'm like, don't think about that, because we have to write this all off. Our goal here is to build generational wealth.
Yep.
Increase our net worth. We're not living in a $20, $30 a month world. That's not going to move the needle for anybody. So we got to think bigger.
Yeah.
So most of our clients, I haven't had too many clients call with issues, any investor clients, because we've set them up this way.
Yeah. So I know a lot of them, my guys, they have 2 or 3 months emergency, but you're right. Like, I didn't account for the line of credit that, yourself and some of my investors set up as well. Because originally, like, we always talk about get that line of credit for, buying your next property, being liquid as much as possible. Right. But now, with the whole COVID-19, it's, you know what, now you can use this line of credit for the emergency funds for anything in case you get laid off for whatever reason. Right.
Pay the debt with the debt. You get to write the interest off. Don't forget that.
Yep.
Interest only payments. Lowest monthly payment available, even lower than an amortized mortgage, even though the interest rate's higher. Lowest borrowing vehicle you could absolutely find outside of the bank of mom and dad.
Yeah. Do you think at some point, if things get really dicey, the line of credits will get shut off and the tap will get proverbially turned off from the banks?
Yeah. So that's a good point you brought that up. I forgot, but there's a lot of small print on the home equity lines that a lot of people don't realize going in. So when you sign a home equity line, there's small print in there that says prime plus 10%. And what that is, and that's
10 basis points or 10%?
10%.
Oh, okay. I thought I heard you wrong.
Okay. No, it's signed in there. Every home equity line you sign, it says, and it basically says, if it hits the fan, on the lender side, they have the ability to raise your interest rate up 10%. They have to go, plus prime. So not a lot of people know that. They also, and this is something we'll talk about, let's say you're carrying $100,000 on a home equity line. It might be in your best interest to lock that in to a fixed amortized, which your lender will gladly do.
Of course, yeah.
Any balance owing on a home equity line, the bank can call it in at any point in time, and they can issue a demand loan, and you have to repay it back within 90 days. So if their balance sheets start getting unlevel, that's an unsophisticated word, but if they start reaching a point where they need to start calling in because they see you're overextended, they do soft pulls, and they realize, we don't like what we're seeing here, they'll go demand loan, boom, 100 grand, 90 days, you have to pay it. If you transitioned that already into a fixed amortized mortgage, they can't touch it for 5 years.
So are you saying that if they do the demand loan, do they give you the option to turn it into a fixed?
No,
Or is
they'll
that too
say
late?
pay it back. Maybe they'll do that. We haven't seen this, right? It's just this is what's in the contract, and these are like worst case scenarios. I've personally never seen it happen in 11 years.
Yeah.
Colleagues of mine have. So will they come to you and it's kind of lock it in? I don't know. I think they're going to look at it a case by case basis, but I'd be a little worried if I was carrying large balances on home equity lines and I was getting a little stretched on my debt servicing, how much debt I had out there.
Mm-hmm.
I'd be a little worried. And if you lock it in, now you've got rid of the risk of the prime plus 10%, and you've got rid of them calling it a demand loan. You have to pay in 90 days.
Okay, so I think we may have freaked some people out here, but like, how likely do you think that's going to happen? And I'm not going to hold you to this, but like, I know you haven't seen any.
I think it's extremely unlikely.
Okay.
But let's say you call in and you said, hey, now we're going down like a rabbit hole here, but let's say you go like.
It's how all our conversations go.
Oh my God, yeah. So let's say you've used the deferral and you miss a mortgage payment.
Yeah.
And you're carrying 80,000 and they do a soft pull and they see like, wow, you missed another payment on your credit. Don't kid yourself. They will call that in.
Yeah.
Right.
Mm-hmm.
So I'd get ahead of it. I wouldn't do it now, but before you start missing payments, go lock in any sort of balances on your home equity.
Yeah. So anyone who may have half listening or is listening, if you're going to miss a payment and you're carrying a large line of credit, you should consider locking in your line of credit because it may get pulled in, right?
Absolutely.
Yeah.
Absolutely. And then you're in trouble.
Yeah.
Yeah. So that's a little thing no one tells you about, right? Yeah. It never comes up because it just doesn't. Everything's good until it's not.
Of course, and that's the whole debt bubble thing everyone talks about.
Yeah.
So let me ask you this question for personally reasons. If I have all these lines of credit and they pull into prime, or so they increase the rate of it, what if they closed line of credit? Should I pull all my money right now so I stay liquid as an investor to buy more properties?
Yeah, that's, it's kind of like, when's the storm going to blow over? Because they're going to be back open for business in a big way at some point.
Yeah.
But, until the storm blows over, are they going to be shutting down access to capital? As I've been told right now, that's not on the horizon. And that's from a very good contact at one of the big banks. They haven't even talked about that from what
that's
I've been
good.
told. Yeah, they haven't talked about that. I think, 1 to 2 months from now, depending on what's happening in the economy, I'll know, me personally, because I'll get to see how they're underwriting deals and what financing they're letting go through.
Yeah.
And then I'll send out to my clients and you, and I'll say, hey, like, if there's money you want to get access to, maybe you pull that and put it in a bank that is not with the bank where the line is.
And
so
this
you don't
is
want to pull your money out from TD.
Yeah.
Put it into a TD bank account.
Yeah, no, that's a bad idea. You want to pull it from TD and put it into like a CIBC.
Correct. So if you have a TD credit card, if you have a TD line of credit, if you're going to miss payments on that, don't keep money in your savings. Transfer your savings to another bank because they will just go in and pull it out themselves.
Yeah.
They will definitely do that without a doubt.
Yeah, money's digital. It's not a vault.
Yeah, absolutely. So on this computer screen, it looks like you've got these accounts, but it's all one big pot on their end. And they will not, without doubt, they will jump in with their fingers and pull out those funds to make those payments.
Yeah. And again, guys, if you're listening, like, we went down a rabbit hole, we got really dark, but we're not there yet. We're not there yet.
We are not there. We definitely. Yeah. I'm an optimistic person.
Yeah.
By nature, and I'm still 1,000% optimistic on.
Yeah. I'm optimistic on this too. Same thinking. I'm just preparing for the worst case scenario if it happens. Yeah.
Yeah. We don't need to jump in the bunker yet.
No, not yet. But like, these are the conversations that I like having. And I love that we're recording this because we talk about these things, but a lot of people don't think about if it happens, right? So they could make the wrong move, not knowing the consequences, right? And I think this is probably very helpful for everyone that's actually listening. Thank you.
I hope so. Yeah. And I hope you are recording. Because
I'm pretty sure. I'm recording. I'm watching this.
I can't do this again.
No, I got it. We got it. We got it. We got the tech stuff sorted. Ryan, before we sign off, anything else you want to add or any kind of tips or tricks for anybody right now? Anything you want to plug?
You know what? I made a couple notes over here. If you let me just, I'm going to
Yeah,
view.
for sure.
I'm just going to see if there's anything that we missed. Yeah, no, we covered a lot. We did. I would say there are, even if things are going so good for you right now, tomorrow they could not. I would still look at ways to optimize your mortgage right now.
Yeah.
And the simple, no cost ways where you're not breaking, paying a penalty, paying an admin fee is just stop your accelerated payments into non-accelerated and re-amortize your mortgage. And so those two things right there could just give you a couple $100s a month leeway, which could help. And it doesn't cost you a penny to do.
Yeah, for sure. For sure.
Okay. But that's it, man. That's, we covered a lot. I hope I hope this helps one person.
Yeah.
Really.
Yeah. All right. Well, thank you for your time, Ryan. Is there any kind of social media, email, phone number, TikTok, Instagram, Facebook you want to leave with the listeners if they want to reach out to you? Yeah, that's getting big now.
Do I have to do a dance right now? Yeah, no.
I think so. Yeah. If you guys are just listening, he I don't know what that was, like a floss robot?
No, I don't know. I have like go-to dad dances.
Dad dances, okay.
Very stereotypical. Yeah, we can be reached, if you have any questions, our email address is info@wileymortgages.com. We also put together a site that we're going to be layering a lot of resources on. It's called protectmymortgage.ca. Then I'll put the link below. Yep. There's a mortgage survival guide there. And we're also going to be layering on a couple other things there in the coming days. So please check that out.
Yeah. So if you guys want access to any of these things that Ryan's talking about, check the show notes or check the description. I'll put it all there for you guys. Okay.
Okay.
All right, Ryan. Thanks for your time, man. Appreciate it.
Yeah, I appreciate what you do, brother. Thanks for having me on, and peace out.
All right. Talk to you later. See ya. Bye.
Okay. Bye.